basically a lot of countries are saying maybe we shouldn't have 100% of our reserves. Maybe we shouldn't have 80% of our reserves in dollars and treasuries because a handful of people in DC can just snap their fingers and seize those funds, or prevent us from accessing that whole ledger and making payments in dollars. And so there's a push by some countries to diversify their reserves. So either a couple different types of fiat currencies, or gold, for example, um, and then also to diversify their payment systems. So instead of being so reliant on Swift and having so many payments basically go through New York, they want to have, bridges between central banks and things like that in order to facilitate more non-dollar trade.
The ongoing de-dollarization agenda of China, Russia, and other BRICS nations has sparked widespread debate. While experts in the United States have differing opinions on its feasibility and impact, investors seem unfazed by the potential shift. Many U.S. investors firmly believe in the stability of the U.S. dollar and the country's global dominance. However, experts acknowledge that the move away from the dollar has been happening gradually for about 2 decades, with the share of the dollar as a reserve currency declining. Sanctions imposed on Russia last year accelerated the process, as countries aimed to avoid similar consequences. In a recent interview, financial analyst Lyn Alden discussed the de-dollarization agenda and its implications, highlighting the changing motivations and survival-oriented approach of countries. The video provides further insights on how trade can be facilitated without relying on the world's reserve currency.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
We don't see like rapid de-dollarization, but we kind of see like no longer increasing dollarization over the
Yeah,
past
okay.
number of years. And then,
Yeah.
this past year, you've seen a little bit more acceleration in de-dollarization. Um, and I think there's kind of two big underlying foundations for that. So number one is that ever since the global financial crisis, and a few years after that, um, a number of countries decided that basically treasuries are probably not going to be very attractive, and they don't want to finance the U.S. government at negative real yields. So I mean, for much of the 2010s decade, for example, T-bills were yielding less than inflation.
Yeah.
Longer duration treasuries were yielding, roughly in line with CPI. It kind of varied over time, and they were underperforming, other assets like equities and real estate and things like that. And so a lot of these governments said we don't really want to, facilitate that. China, in particular, in 2013, said it's no longer in our interest to keep accumulating treasuries. They just made to come out with a statement. And so what China was at the time in the prior decade, the biggest, net buyer of treasuries. And so what China started to do instead, for example, is they started to use their dollar surpluses, their dollar trade surpluses, instead of funneling them back into the US Treasury market, they started making loans. Say that, the Belt and Road Initiative. They started doing kind of like what the IMF and World Bank do, on their own scale, where they go to countries in Africa or other countries in Asia or certain countries in Latin America or Eastern Europe, and they say, okay, we're going to provide dollar loans in order to build this, railway or this commodity development or this refinery. And so they found that to be a better use of their dollars than plowing them back into treasuries. You had other central banks, like say, the Swiss National Bank, plow it into U.S. equities, rather than U.S. treasuries. And the other ones, just, the dollar was pretty strong, especially, starting in 2014, 2015. And so many countries were just kind of not accumulating reserves and therefore just not accumulating much treasuries, in general. You also saw from the 1970s until around 2009, there was this like net reduction in central banks holding of gold. Kind of, it was like the slowly declining gold stash. But starting in 2009, you had like a V-shaped recovery, where central banks began reaccumulating gold, on net. And so they found that, to potentially be a better, reserve asset for them. So that's number one, is basically the unattractiveness of treasuries that don't keep up with inflation, which is an environment we've been in. The other one is basically that the treasury and the dollar market in general is a permissioned ledger. So it's a ledger that, you can be cut off from. Your assets can be unilaterally seized. And, obviously it's not done arbitrarily, but, most countries around the world have had periods of time over the past, say, 50 years where they've not been in the good graces of Washington for one way or another. The severity can obviously differ. Sometimes it's like an outright war. Other times it's just, various agreements. Maybe the Treasury doesn't want India doing business with Russia, and India says, well, we're going to do business with Russia. And so India is not in the bad graces of Washington, but it's not maybe not the best graces of Washington. So basically, a lot of countries are saying maybe we shouldn't have 100% of our reserves. Maybe we shouldn't have 80% of our reserves in dollars and treasuries because a handful of people in DC can just snap their fingers and seize those funds, or prevent us from accessing that whole ledger and making payments in dollars. And so there's a push by some countries to diversify their reserves. So either a couple different types of fiat currencies, or gold, for example, and then also to diversify their payment systems. So instead of being so reliant on Swift and having so many payments basically go through New York, they want to have, bridges between central banks and things like that in order to facilitate more non-dollar trade so that they can't have their payment systems shut off either. So both as protection for their savings and payments, on a permission ledger, they want to have basically an assortment of other payment and savings mechanisms to choose from.
During a discussion, U.S. Treasury Secretary Janet Yellen highlighted the growing threat to the United States and the dominance of the U.S. dollar on the global stage. Yellen acknowledged that the sanctions imposed on countries like Russia posed a risk to the dollar's hegemony as the world's reserve currency. However, finding a viable alternative to the dollar would not be easy for countries seeking to boycott it. Yellen emphasized that the dollar's status as a global currency is due to unique properties that are difficult for other currencies to replicate. She also emphasized the importance of robust U.S. capital markets and the rule of law, which contribute to the dollar's global role. Despite this, financial analyst Lyn Alden suggests alternative ways for countries to facilitate international trade without relying on the U.S. dollar, and explains why central banks are increasing their holdings of gold.
Yeah, I think they'd have more freedom with their reserves. They also might be able to hold less reserves because, like, nobody exactly, for example, wants to hold a lot of Chinese bonds. They don't want to have 50% of their central bank reserves in Chinese assets. It's got capital controls. It's not super attractive. But China, for example, is the largest trading partner with most countries in the world now. Over the past 20 years, they've surpassed the U.S. For most countries as their biggest trading partner. And so, with, let's say, China and Brazil trade, Brazil sends a lot of commodities to China, and China sends a lot of electronics, and other products to Brazil. And so one thing they can do is just basically, like, one of them gets a temporary surplus and then it gets plowed back into the goods of the other one. You have that more circular payment system that doesn't really need to use the dollar. And they both might hold some degree of each other's reserves, with excess reserves maybe going over into gold, or something like that. That's generally kind of a trend we're seeing. And so, while I don't think you'll see massive reserves, in these other types of countries, I think we're slowly seeing a diversification of reserves. I mean, Chinese holdings of Chinese, assets, among global central banks, over the past, say, 5 years, went from virtually zero up to, you start to see countries doing 3, 4, 5% of their reserves in that. So it's a marginal change, which then we also combine with, gold increases. You have a little bit less focus on American and European assets as reserves, and a little bit more focus on BRICS, gold, that kind of thing. People in the past, when they talk about prior, global reserve currencies, they act as though there's just kind of a different reserve currency over time, which is partially true, but all those past ones were basically just proxies for gold. I mean,
Right.
central banks would hold gold. Sometimes they'd accept each other's, payment ledgers and bonds and things like that as gold proxies that are maybe more convenient and pay some interest. But essentially gold was at the center of the system. And since the 1970s, the Treasury kind of replaced gold as a key part of the system, which is that, instead of holding a gold proxy, all these central banks around the world will hold dollars and treasuries as usually their primary asset. And that system kind of reached its peak in the early 2000s. And so I think we are starting to see a reversion to the mean where gold is becoming, a kind of regaining its kind of centrality, among at least some countries' reserves. And other things too, like, just basically loans to other countries that are kind of indirectly tied to hard assets, like loans to make infrastructure or commodity deposits or refining stuff. Sometimes that comes with a caveat that if those loans are defaulted on, then the rights of those assets get transferred to the lender. And so I think we're seeing a little bit more kind of hard asset commodity gold preference. The challenge, of course, is one, those types of things are less liquid. Um, they can't be used for fast payments. And then also, the advantage of self-custody gold is that a country actually holds it, whereas a problem with those types of lending environments is if they're defaulted on, how do you enforce your property claims
Right.
in another country?
As countries shift their focus towards gold instead of the US dollar, it indicates a growing interest in hard money. It's only a matter of time before they consider including Bitcoin in their reserves. However, some qualities of crypto assets, such as the transparency of the blockchain and Bitcoin's fixed supply, may not be acceptable to central banks. They tend to prefer the lack of transparency and accountability that fiat currencies provide, as it allows them to have control over printing money at will. This is why central banks around the world are exploring or implementing central bank digital currencies, as they see digital currencies as the future that they can control. What are your thoughts on Lyn Alden's interview? Do you believe the BRICS alliance and its proposed common currency pose a significant challenge to the United States and the US dollar? Feel free to share your comments and observations below. For more Daily Dose Crypto news, check out these two awesome videos on your screen. Click now and we will see you on the next video.